Welcome to Siwale Production. Today we're going to be looking at the solutions of Accounts Paper 2 2016, and specifically we're going to be looking at question 2C and question 2D. So question 2C reads, define the term depreciation and name one cause of depreciation. So depreciation is the loss of value of fixed assets over a period of time. So let us write down our definition of depreciation. So depreciation is the loss of value of fixed assets over a period of time. So that's the definition of depreciation. So depreciation is the loss of value of fixed assets over a period of time. And the other part of the question reads, and name one cause of depreciation. So we need to name one cause of depreciation. So I'll give you some of the causes of depreciation. So depreciation can be caused by tear and wear. So we have tear and wear can cause depreciation. Then the other cause is decay. Then the other cause is depreciation. The other cause of depreciation is erosion. And the other cause of depreciation is inadequacy. So these are some of the causes of depreciation, and according to our question, it just requires one, so you can just give one cause there. Let us proceed and let us look at question D. Question D reads, A. Musonda bought 4 machines on credit from Mazembe Equipment Limited on 1st January 2010 for 20,000 kwacha each. So before we proceed, let us underline our keywords there. So A. Musonda bought 4 equipments on credit from Mazembe Equipment Limited on 1st January 2010 for 20,000 each. So we can underline that. We can underline our 20,000, and we know that he bought 4 machines. The question proceeds, he charged depreciation on machines 20% per annum each year by reducing balance method. So he charged 20% per annum each year by reducing balance method. The question proceeds, the policy is to charge a 4 years depreciation in the year of purchases but not charge any in the year of sales. Even this point is very important. So this point reads, the policy is to charge a 4 years depreciation in the year of purchases but not charge any in the year of sales. 2 of the machines were sold for 13,000 kwacha each by cash on 1st October 2012. So 2 of the machines were sold on 1st October 2012. The question proceeds, on the same date, 2 replacement machines costing 24,000 kwacha each were bought for cash. So on the same date, 2 replacement machines were bought for 24,000 cash. A. Musonda's financial year ends on 31st December 2012. Required, prepare the provision for machinery depreciation account for 3 years. So we have 2010, 2011, and 2012. So there we're supposed to prepare the provision for machinery depreciation. So before we prepare that, the provision for machinery depreciation, let us look at the double entry system of depreciation. So the double entry system for depreciation, there we debit our profit and loss. So you debit your profit and loss and you credit your provision for depreciation. So we're going to credit the provision for depreciation account. So that's the double entry system for depreciation. And to answer our question, we're going to first start by calculating depreciation for the year 2010. So let us look at the question, what it says. So A. Musonda bought 4 machines on credit from Mazembe Equipment Limited on 1st January 2010 for 20,000 each. It charged depreciation on machinery 20% per annum each year by reducing balance method. So for the year 2010, the thing that we know is that 4 machines were bought at a cost of 20,000 each. So we can say 20,000 each. So to calculate the total of these 4 machines, we're going to say 4 multiplied by 20,000 and we're going to have 80,000. And for us to calculate depreciation for the 4 machines in the year 2010, we're just going to say 20 divided by 100 multiplied by 80,000. And our answer there is going to be 16,000. So 16,000 is the amount of depreciation that we are going to record in the year 2010. So let us record that in our books. So as you can see, I've already written the title there. The title reads A. Musonda Provision for Depreciation Machinery Account. So for the format, we have the date in the first column, details in the second column, folio in the third column. Then we have our debit and our credit. And I've already written the year 2010 and our currency there, it's in kwacha. Then we also know that M. Musonda's financial year ends on 31st December 2012. So here we can say on the 31st of December, we are going to record the depreciation that we have calculated in the year 2010. So in our details there, we're going to put profit and loss. And since at the start I said that the double entry system for depreciation is that you debit the profit and loss and credit the provision for depreciation. So we are going to credit 16,000 there. And after we do that, we're going to find our total. So our total there is going to be 16,000 on both the credit side and the debit side. Then there we're going to write down the balance carried down. And the balance carried down is going to be recorded on the 31st December. So we have our balance carried down. So to balance up the debit side, we need to add 16,000 on the debit side. And you're going to write down the balance brought down. So this will be in the following year, which is 2011. So we can say our January 1st. So this is going to be balance brought down. So we're going to have 16,000 on the credit side. So that's how you can record for 2010. Let us look at how you can record for 2011. So the other information that we've been given reads, the policy is to charge a full year's depreciation in the year of purchase but not charge any in the year of sales. Two of the machines were sold for 13,000 kwacha each by cash on 1st October 2012. That means that in the year 2011, nothing occurred there. We did not buy or sell any machine. So we are going to calculate depreciation for the year 2011 there. So we can put our 2011. So for us to calculate depreciation for the year 2011, and since we are using reducing balance method, we are going to say our cost of the 4 machines there, we know that that's 80,000. We're going to say minus the depreciation that we calculated, which is 16,000. So our answer there is 64,000. And we're going to calculate depreciation on 64,000. So multiplied by 20% or 20 divided by 100. And our answer there is going to be 12,800. So that's the amount of depreciation that we're going to record for the year 2011. So we're going to say that 1st December there. In our details, we're going to put down profit and loss. Profit and loss. So we have calculated our depreciation for the year 2012 as 12,800. And we're going to put our totals there. So we are going to add the credit side. We're going to add 16,000 plus 12,800. And our answer there is 28,800. And you're going to record that on both the credit side and the debit side. And we're going to write down our balance carried down there on 31st December. So we have balance carried down. So our balance carried down is going to be on the debit side with the amount of 28,800. Then our balance breakdown is going to be written in the following year, which is 2012. So we can say 1st January there. So we have 1st January. Then we can put our balance brought down as 28,800 on the credit side. So in the year 2012, that's where some interesting things happened. So let us read the question again. So from here, the policy is to charge a full year's depreciation in the year of purchases, but not charge any in the year of sale. Two of the machines were sold for 13,000 kwacha each by cash on 1st October 2012. So in the year 2012, we sold two of the machines at 13,000 kwacha. On the same date, two replacement machines costing 24,000 each were bought for cash. So let us calculate for the year 2012 there. So in the year 2012, two of the machines were sold at 13,000. So we can say two machines were sold for 13,000. And since we know that two of the machines were sold for this amount, we need to calculate the depreciation of these two machines, and we need to calculate the depreciation for the year 2010 and for the year 2011. And after we calculate the depreciation for the year 2010 and the year 2011, we are going to write them off from the provision of depreciation. So for the year 2010, we know that the cost of one machine is 20,000 kwacha. Then we know that we sold two machines there. That means that the total there is going to be 40,000. Going to be 40,000, and we're going to calculate depreciation for 40,000 in the year 2010. So there, the amount is going to be 8,000. So that's the amount of depreciation for the two machines in the year 2010. What about in the year 2011? So to calculate the depreciation in the year 2011 for the two machines, we're going to say the cost of the two machines, which is 40,000, minus the depreciation of the two machines, which is 8,000. Our answer there is 32,000. So we're going to say 20% of 32,000 there. Our answer is 6,400. So that means that we need to write off depreciation of the two machines for 2010 and 2011. So we are going to add 8,000 plus 6,400. And there, the amount there is 14,400. So we are going to record that. So we can say 1st October there. 1st October, we need to record our disposal of depreciation, since we sold the two machines, and our amount there is 14,400. Then let us calculate depreciation of the remaining two machines in the business. Since we sold two machines, that means that we are remaining with extra two in the business, and we need to calculate depreciation for them in the year 2012. So we have our 2012 there. So we need to calculate depreciation for the other remaining two machines. Then in the year 2012, we know that the cost of the machine for the year 2011 was 32,000. So we're going to say 32,000 minus the depreciation of the two machines, which is 6,400. So our answer there is going to be 25,600. 25,600, and we're going to calculate 20% of that. And our answer there is going to be 5,120. So that's the depreciation of the remaining 2 machines in the business for the year 2012. And let us look at the question. The question also reads, on the same date, 2 replacement machines costing 24,000 each were bought for cash. So we need to calculate depreciation of the 2 replacement machines that were bought. Since the question here, it reads, the policy is to charge a full year's depreciation in the year of purchases. So we are going to calculate a full depreciation for the 2 machines. So for the 2 machines, we know that each cost 24,000. So we're going to say 24,000 multiplied by 2 there. We're going to have 48,000. So we're going to calculate 20% of that. And our answer there is 9,600. So the depreciation for the year 2012 there, we're going to add 5,120 plus 9,600, and we're going to have 14,720. So we can say that 1st December there. And in our details, we're going to put our profit and loss, and I've just calculated as 14,720. Then we're going to calculate our totals there. So there, our totals, we're going to discover that the credit side is going to be more than the debit side. So we're going to add 28,800 plus 14,720, and we have 43,520. We're going to record that on both the debit side and the credit side. So on 31st December, we're going to put our balance carried down there. And for us to find our balance carried down, we're going to subtract 14,400 from 43,520, and our answer there is 29,120. So there, in the next year 2013, we're going to put our balance breakdown. It's going to be on the 1st January there. So we're going to say balance breakdown as 29,120. So that's how you can write up a Musunda provision for depreciation account. So where you have questions on this paper, make sure you put them in the description section of this video. So before I let you go, I just want to let you know that our online tuitions are available and they go at 100 kwacha per subject.